price of gold recovered quickly and managed not only to close positive on the day, but positive on the week and back above 2,000, even though we had all these higher than expected inflation numbers that have pushed back the expectation of when the Fed is going to start cutting rates. I think that's a very strong sign in the gold market. Everybody is writing gold's obituary. It's not dead. It's alive and well. It's over 2,000. But the most important thing is the fundamentals have never been better. Not only do the charts look great for gold, but the fundamentals are fantastic because we're in a situation where we have inflation that has just bottomed at about 3%, is now headed higher, and there's nothing the Fed can do about it.
Gold's price dynamics this week followed the anticipated pattern, with inflation data shaping market sentiment. A notable event was the sharp price drop on Tuesday, following the release of hotter-than-expected consumer price index data for January. The metal's price plunged from nearly $2,030 per ounce before the release to $1,991 an hour and a half later. After that, gold mostly traded within a narrow $12 range on both sides of the $2,000 level, with another smaller decline occurring after Friday morning's producer price index release. American stockbroker Peter Schiff, chief economist and global strategist at Euro-Pacific Asset Management, remarks that gold's dip below $2,000 could signal the final shakeout before it hits new highs. He points out that although inflation rates have decreased from previous peaks, this doesn't necessarily mean that inflation will drop to the expected 2%. Several economic indicators suggest the potential for higher inflation in the future. The short-term trajectory of gold hinges on economic data and its impact on the dollar, bond yields, and expectations for interest rate cuts. Central banks and retail investors, especially in China, continue supporting gold prices despite the recent downturn. Although physical demand is expected to remain robust, outflows from exchange-traded funds will likely constrain upside potential until the rate cut cycle begins. Peter Schiff mentions that higher inflation figures prompt some investors to sell gold as they interpret it as an indication that the Federal Reserve might need to intensify its efforts to combat inflation, possibly leading to higher interest rates. The latest Kitco News Weekly Gold Survey indicated a divergence between Wall Street and Main Street in price expectations. Many retail investors anticipated potential gains for gold the following week, while analysts leaned toward expectations of a slide in precious metal prices. Join us as we delve into insights shared by Peter Schiff. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
There was a lot of action in the gold market this week after spending a record 41 consecutive trading days, not calendar days, but trading days above 2,000 without trading below it at all. Gold finally plunged below 2,000 on Tuesday. It dropped about $30 an ounce, and it was trading at about $19.90, a little bit lower, and it stayed at that level on Wednesday as well. But on Thursday, it got back above 2,000, added to those gains today. So it closed the week about $2,013 an ounce. It was actually up about $1 or $2 on the week. And I think that this move below 2,000 could be the final shakeout for gold before it moves up to new highs. Now, the catalyst for that move on Tuesday was, ironically, the release of a hotter than expected January CPI number, meaning that the inflation numbers came out higher than the markets had expected. In fact, they probably expected good news. They probably thought that we'd get lower numbers than was expected, and instead it was the reverse. Now, I say it's ironic because gold is an inflation hedge. The point of buying gold is to protect you from inflation. It preserves purchasing power. It's a store of value. So it should be good news that inflation is worse than people expected, because that means there's more reasons to buy gold. But the way it's worked for the past year or so is the reverse. It's been higher than expected inflation news that's caused gold to sell off. It's when inflation comes out lower than expected that people want to buy gold. Again, why would that happen? Because it makes no sense fundamentally that that would be the case. Well, the reason is because every time the inflation numbers are higher than expected, the market expects the Fed to have to fight a little bit harder to win the inflation war. And it's that harder fight that gets traders to sell gold. In fact, I don't even think anybody decides to sell. I think it's already programmed into the trading algorithms. Anytime inflation news comes out lower than expected, these algorithms are pre-programmed to sell gold, to buy the dollar, because they think it means a tighter Fed, that it's going to be higher for longer, that we're going to have to wait a little bit longer for the first rate cut, and therefore that means gold's going to have a problem. But the markets still haven't figured out, and I think they will soon. Hotter than expected inflation doesn't mean the Fed just has to fight a little harder to win the inflation fight. It actually confirms that it's already lost. The idea that inflation is going to go down to 2% is farcical. There's no way that's going to happen, and I've been pointing that out. Yes, we went down from 9% to 3%, but that doesn't mean we're going to just glide down to 2%. If you look at all the fundamentals, everything points to higher inflation, a resurgent CPI. If you look at all of the factors that should have been influenced by higher interest rates, because the way higher rates are supposed to reduce inflation is by reducing demand. They reduce spending. They make it more expensive to borrow. And so you borrow less, you spend less. But none of that has happened.
An intriguing development has emerged in the market, particularly concerning gold tracking ETFs, which have seen noteworthy outflows amounting to $2.39 billion. This descent in gold ETF prices reflects the ongoing challenges within the industry. Concurrently, there has been a surge in interest in Bitcoin spot ETFs, with inflows totaling $3.89 billion in 2024. The stark contrast between gold and Bitcoin ETFs suggests an experimental shift, signaling an increased curiosity in exploring alternative investment avenues. According to Bloomberg analyst Eric Balchunas, a significant portion of leading gold ETFs have experienced a downward trajectory marked by substantial outflows. Only a handful of ETFs have seen minor inflows, indicating a distinct price disparity. Peter, the speaker, underscores the remarkable rally witnessed in Bitcoin ETFs this week, characterized by notable inflows and outflows compared to gold ETFs. Despite the attention on Bitcoin, Peter emphasizes that the pivotal action will occur in the gold market. He highlights that gold's fundamentals are currently optimal, as inflation is climbing, and the Federal Reserve's measures to combat it are insufficient due to the necessity to maintain a fragile economy and bolster President Biden's re-election prospects. Let's get back to the interview.
Price of gold recovered quickly and managed not only to close positive on the day, but positive on the week and back above 2,000, even though we had all these higher than expected inflation numbers that have pushed back the expectation of when the Fed is going to start cutting rates. I think that's a very strong sign in the gold market. Of course, there was weakness again in gold mining stocks. They finished down on the week. They really got clobbered on Tuesday when gold went down because there's so much fear in the gold stock market. And I think that is a very strong contrarian indicator that we're at the bottom when so many people are fearful. In fact, Barrick Gold this week, which is one of the bellwether stocks, made a 52-week low on the week. Even though gold barely went below 2,000, you're talking about a major mining company where sentiment is so negative that it traded at a 52-week low. And I think another contrarian indicator on the week had to do with the rally in all these new Bitcoin ETFs, which rallied big and made new highs. And I saw a lot of people posting charts that showed huge outflows of the gold ETF, GLD, and big inflows into the Bitcoin ETFs. And they're trying to say that, see, everybody is moving out of gold ETFs into Bitcoin ETFs. Now, I doubt much of the money that went out of the gold ETFs actually went into these Bitcoin ETFs. I think a lot of these gold investors are throwing in the towel. It doesn't mean they're necessarily buying Bitcoin just because they're selling their gold, but I think the Bitcoin pumpers are trying to pretend that this is what's going on, although it certainly is possible that some of the money that went out of gold ETFs went into Bitcoin ETFs. My guess is most of it just went into money market or maybe into the stock market, but not into these ETFs. But I think the fact that you got this big rally, and I think the catalyst for the rise in the Bitcoin ETFs, first of all, they all dumped about 20% immediately after they were first launched. But there was a big ETF conference down in Miami this week, and Bitcoin is notorious for pump and dumps around these type of events. So I'm sure there was a lot of hype, a lot of pomp and circumstance about the Bitcoin ETFs. I mean, they were probably the talk of the conference, and so that probably caused a lot of people to buy and pump up the price. So my guess would be next week we'll see the dump following this week's pump. But I think where the action is going to be is in gold. Well, everybody was sidetracked by what was going on in Bitcoin. They overlooked what's going on in gold. Everybody is writing gold's obituary. It's not dead. It's alive and well. It's over 2,000. But the most important thing is the fundamentals have never been better. Not only do the charts look great for gold, but the fundamentals are fantastic because we're in a situation where we have inflation that has just bottomed at about 3%, is now headed higher, and there's nothing the Fed can do about it. It is out of ammo. It can't fight. There is no way the Fed is going to hike rates. It would crash the economy, and it would sink any chance Biden has of getting reelected, if he even has much of a chance to begin with. And the economy is weakening, making it even harder for the Fed to hike rates, because how can it ignore a weakening economy and hike rates anyway? So it's going to dismiss any increase in inflation.
Do you align more with the expectations of retail investors, anticipating potential gains in gold, or with the analysts predicting a slide in precious metal prices? What factors are influencing your stance on the price movements of gold shortly? Share your thoughts in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.